Hey CPA candidates, welcome back to our channel where we make accounting simpler, one concept at a time. Today we're diving deep into a crucial topic for the FAR exam subsequent events. Whether you're a month out or a week away from exam day, we've got you covered with key concepts and practice questions you need to know. Let's get started. First up, let's talk about subsequent events and their two types, recognized and non-recognized. Here's a question to get you thinking. On March 15th, Year 2, a calendar year company issued its Year 1 financial statements. On March 1st, Year 2, a fire destroyed the company's only manufacturing plant. How should the company treat this loss in the December 31st, Year 1 financial statements? The correct answer is C. Why? This event is a Type 2 subsequent event. The fire occurred after the balance sheet date, so it is unrecognized. But it must be disclosed to keep the financial statements from being misleading. Always remember, Type 2 events aren't recognized but disclosed. Now, let's focus on disclosures. Here's the next question. Under what circumstances are disclosures required for subsequent events? The correct answer is A. Why? Disclosures for subsequent events are only necessary when the financial statements include notes. No notes? No disclosures. Next, let's test your knowledge on non-recognized events. Which of the following statements is false concerning subsequent events? The answer is D. Why? Entities can, and should, disclose estimates related to conditions at the balance sheet date if they provide additional evidence about conditions that existed on the balance sheet date. Statements like D would make your financial statements misleading. Here's a classic test of recognition. Which item would most likely require a subsequent event adjustment to the financial statements for the year ended December 31st, Year 1? Answer: C. Why? If the customer declared bankruptcy in Year 2, but the receivable existed in Year 1, this event requires adjustment since it provides evidence about conditions at the balance sheet date. Let's move on to how management handles subsequent events. The disclosure requirement related to the date through which management has evaluated subsequent events needs to be implemented without regard to which of the following. Answer: D. Why? The disclosure must be made regardless of whether the financial statements are compiled or prepared under GAAP or OCBOA. Disclosures are essential for transparency, no matter the level of service. Here's a question about post-balance sheet events. Zero Corp. Suffered a material loss due to a customer going out of business after the balance sheet date but before the financial statements were issued. How should this be handled? Answer: D. Why? The bankruptcy is a Type 2 subsequent event. Since it didn't happen by the balance sheet date, the financials shouldn't be adjusted, but the event is material and requires disclosure. Another common situation is natural disasters. On February 28, Year 2, a storm severely damaged a company's plant. The financials were issued March 21st, Year 2. How should the impact of the storm be reflected in Year 1's financial statements? Answer: C. Why? This is another example of a Type 2 subsequent event. The event did not exist at the balance sheet date, so no accrual is needed, but it's material and should be disclosed. Lastly, let's test stock issuance. Little Corp. issued 50,000 shares on March 1st after its December 31st year-end. How should this be reported? Answer: D. Why? Stock issuance that happens after year-end is a non-recognized subsequent event. It doesn't need to be adjusted but should be disclosed in the notes. That's it for today's video. We covered a lot, from Type 1 and Type 2 subsequent events to how to recognize and disclose them. If you found this helpful, make sure to hit that like button and subscribe for more CPA exam tips and strategies. Keep studying hard, and I'll see you in the next video.